I want to welcome you to the Option Pit webinar of the month. Today, we're going to be talking about riding the option wheel. If you aren't super familiar with us, Option Pit is a full service mentoring and consulting firm. We work with individual retailer traders with as little as $5,000 or $10,000, and we work with funds and individuals that range into the billions of dollars. I like to say I've got clients that have 15,000. I've got clients that have 15 billion. The nice thing is that, interestingly, they have a lot in common. On that, let's get down to business, and that is riding the wheel. All right. So what you're going to learn today is the structure of a covered call, the structure of a cash-secured put, how time premium decays, the perfect covered call, the perfect cash-secured put, the 5 secrets of a great covered call / cash-secured puts, and then how to trade the triple income wheel, and then I'll show you an example. All right? So what is a covered call? A covered call is a combination of long stock and a short call. Real simple. All right. The combination creates positions that can produce positive cash flow, increase an investor's margin for error, and help the investor make sell decisions. One of the biggest issues I see with investors is they buy into a stock and they ride it up and they don't ever get out of it. Well, that's one of the things covered calls can make traders do is, forcefully exit a trade or a long position. So let's kind of talk. So this is obviously an older trade, but this covered calls is not like a this is kind of an evergreen example. This is one of the nice things. All right. So Triple M is trading $97.30 as opposed to its current price of like $147, I believe. So it's trading $97.30. All right. So it starts with that long stock position. Then against that, we would sell a call. So I would sell a 97.5 call at $1.63. Real simple. So by owning the stock and then selling a call, the combination of graph that now looks like this. All right. Notice my break even has gone from 97.29 to 95.66. All right. Now in return, one can see that my profit is capped. All right. You see, it doesn't just go up forever like a stock position. So that is the negative. So we collected the premium on the trade, which lowers our cost basis on the stock. All right. We limited our upside because if the stock moves above our call strike price, our stock will be called away. All right. Now our break even is now 95.66, but the most we can make on the stock call combo is $99 and is 99.13. All right. So below 95.66, I begin losing money at expiration, and above 99.13, I stop making money. All right. So the lowdown. All right, what is the yield of the trade on a takeout? All right, the stock price is 97.29. All right, the strike price is 97.5. The option price is $1.63. So the total return is the strike plus the option price minus the stock price over the stock price. So the total return is about $1.84, or call it 1.8%. All right, typically on full margin, I'm looking to make 1% on short puts or on covered calls. All right. Does that make sense to everybody? All right. So here's an example where it makes a big difference. So this is an old example of Apple from last year, but it was a classic example because the stock, really, it goes through these weird periods where it moves, then it stops, then it moves, then it stops. And if one can kind of take advantage of the fact that it doesn't move, I want you to look at this 3-month period where one could be selling covered calls. So imagine I buy Apple stock for $40.50, and then I sell the February 450 call, and I collect $13.50. All right. I then buy it back for $10.25, so I make $3.25. All right. In February, I sell it $13.60, and I buy it back for 2 cents, so I keep $13.58. And then in March, I'm selling now an April call. I sell the 445. I sell the call at $14.75, and I exit it and the stock simultaneously. I make $1.50 on the stock, and I lose $17.80 on my covered call. But in total, over this period, if I just did the stock, I would have made $1.50. All right, by selling these covered calls, I made 13.5% over that period. All right, makes a big difference. All right, that's really where covered calls can show their teeth. You know, there's a lot of stocks right now that have basically just kind of stopped moving. That's my dog. Are you at Susan's? No, I'm not, but my neighbor was shaking around and it's dark out. But that's the nice thing. Sweetest dog ever, but very, very intimidating bark, which is, you know, much like me, my bark is bigger than my bite. So now management mechanics. All right, this is one of the things that I do. So in that case, I was managing that position. All right, but if one of the things that I like to do is I always like to cover my position rather than letting it expire worthless. All right, if you do not get the stock called away, buy the call back and sell another expiration. All right, and this is almost always true. If I can buy the short callback for less than a nickel, even with commission, all right, it almost always makes sense to cover and roll back to a different position the next month out. All right, even with the commission, and there are lots of good reasons why, and I'm happy to go through them, but generally, if you can buy the callback for a nickel, it's worth it to buy it back and then go out and sell the next expiration out. All right. If the stock runs through the call, let the stock get called away, then take a day or two, then decide to enter the trade again. So one of the things I've noticed with people is, you know, they tend to get married to a stock. Oh, I've had that in my portfolio forever, blah, blah, blah. Well, if you get a stock called away, before you go in and buy it, I mean, at a minimum, wait the 30 days. That, you know, obviously if it's just been something that you've owned for a couple of months, you don't need to wait. But if it's something that you've got a long-term capital gain on, wait the 30 days and maybe spend a little time looking for other candidates to own. All right? Getting stock called away can be a great opportunity to evaluate whether, you know, what your concentration in that stock is and whether that's one that you want to keep owning. All right? All right, so now, what trade does this look like? It looks a lot like our covered call position. And that's kind of what a cash secured put is. All right, a cash secured put, and we're going to talk about this. Yeah, it's a short put. But a cash secured put, well, it says right there, this is a short put. But a cash secured put and a covered call are very similar in nature. So here's selling an out-of-the-money put. Here's selling an out-of-the-money call. One can see the differences. All right. The cash secured put has almost all of the same risk characteristics as a covered call. All right. The main difference in terms of risk comes from assignment. All right. A covered call will only get called away when there is a dividend. An option is in the money expiration. All right. Those are the only real reasons why you should get assigned. All right. Theoretically, you should never be early exercised on a call unless it has a dividend. Doesn't mean it can't happen, right, that you get assigned. It's silly, but it happens. All right. And then the other reason is at expiration if that call's in the money. All right. Now, the big difference, here's the big difference. The seller has the stock taken away. All right. So at expiration, the covered call that's in the money has the stock taken away from the owner. All right. So now let's look at the assignment for puts. A cash secured put will get put to the trader when an option is in the money at expiration. An option becomes extremely in the money prior to expiration. And this is related to carrying cost. All right. And the seller has the stock given to them or put to them rather than. So the big difference is that assignment you take ownership, whereas with covered calls, at assignment you lose ownership. All right. Interestingly, by the way, here's a little trick. Does anybody here know how to tell if an underlying is going to get assigned to you? I'll show you this. Thinkorswim. Based on the extrinsic, yes, that's correct. Yep. Dividend is greater than the put, right? That's exactly right. I'm going to show people this, though. This is kind of interesting. Good call, John. That's an ex-student of mine. So, well, thank you. So let's say that Apple goes ex-dividend tomorrow, all right, with a $1 dividend, all right, and I am short, and I'm short the 112 calls, all right. So the way I do the math is I look at how many dividends I would collect between now and this expiration cycle, all right. And if that dividend number is greater than the value of the put, there are very good odds that I will be assigned. So pretty good odds I'm going to be assigned on any call below 14. At the 114 strike, I would say it's probably somewhere around 50-50. All right, some people will still exercise those. Now, here's one thing to remember. Let's say I've got short the April calls, all right, and I'm short the, let's say I'm short the 97.5 calls, all right, and I look and say, well, Apple has a $1 dividend, but these puts are worth more than that $1. Well, guess what? You're still going to get assigned because remember I said it's the total amount of dividend that will be collected between now and expiration. Apple is going to have a second dividend between now and April expiration if it goes ex-dividend tomorrow. Okay, so I actually have $2 of dividend to deal with. So I am on the hook all the way up to 99.29. That is how one can tell whether they're going to be assigned. Everyone understand that? All right. All right. The major difference in the mechanics, you vaguely understand? All right. Basically, just remember, total amount of dividend between then and an expiration, between today and expiration, if it exceeds the value of the put, there's a good chance you're going to be assigned. So if I'm going to collect 2 dividends between now and that expiration, and the put is worth any less than $2, there's a good chance I'll get assigned. Good. So the major difference in mechanics is that the cash secured put should be sold slightly out of the money below the underlying instead of near the money or out of the money above the underlying. All right? If the put, and again, if the put can be bought back for less than a nickel, buy it back and sell another put. If the stock gets put to you, be willing to accept delivery, be prepared for a wheel trade, which we will discuss in a bit. All right? Now, one of the reasons why, and I'm going to talk about this, but we're going to talk. I'm going to tell you why you buy these back for a nickel in a minute. All right. At 30 days to expiration, at the money options see a dramatic increase in time decay. All right. Early sales decay more slowly. All right. In the final week, the call or put still has a huge portion of decay to lose. All right. New traders need to think about the duration of the call or put they sell. All right. As they become better traders, they may want to adjust the duration of the trade. So premium selling. All right. This is a chart of option premium at the money. All right. And really, if I was going to really redraw this chart, here's how I would do it. All right. I would actually draw it this way. All right. And this is really how options decay. And what this represents, all right, so this is kind of, in terms of value, this is 10 cents. Call this 10 cents. For like a normal stock. All right. All right. Once it gets to 10 cents, 10 cents or a nickel, decay really starts to slow down. All right, and then you get all this decay in the final, the final couple of days. So the thing to think about is, where's the decay greater, here, or if I go back to, let's say, like 45 days, is the slope steeper here? You know, if this is, let's say it hits 10 cents at 10 days. All right. So is the slope from day 10 to day, let's say 2, so this 8-day period, am I collecting more decay here, or do you think I'm collecting more decay up in here? Yeah. All right, that is why when an option gets to a nickel, buy it back and roll it. You will make more money. All right? And I know people hate paying commissions, but if you've got a decent broker, they should not be a problem. All right, so I would strongly encourage traders, buy them back for a nickel, go sell whatever at a different expiration. And there are some of the brokers, if you're buying something for a nickel or less, you don't get charged a commission. All right, weekly versus monthly. All right. Now, between August, so we're going to look at Facebook. All right, between August and Sep, and Facebook really isn't a great candidate for I mean, if you wanted to get long Facebook, it's fine for a put trade, but it's maybe not perfect for a lot of other things. All right, So between August and SEP expiration of 2014, there were 4 weekly contracts. All right. Facebook was trading a little over $73. Would I rather have sold the AUG SEP weekly 74 calls, all right, 4 times, or the SEP 5 calls once as a covered call trade? Let's take a look at the option montage. So here's the question. Would I rather sell with the, so let's say I buy Facebook for 73.5. All right. Would I rather sell the 74 calls on August 8th and then assume I could get 74 cents again, 74 cents again, 74 cents again, 74 cents again, or would I rather just sell the SEP 5s and collect $2.40? Well, take a look. If I sell one option a week at 74 cents, I collect $2.96. If I sell one at $2.40, I collect $2.40. All right. Even if you assume that I pay 5 cents to buy all those back, all right, and I only pay 5 cents once, and you add in transaction costs. So let's just do this. All right. Let's say that it costs me $1 per trade. All right, $1 a contract, and I'm doing one contract. All right. So I sell at $2.40 and I pay a nickel, so I make $2.35, and I pay $2 in commission. So I make a total of $2.33 in premium. All right. Now in my 4 1 lots, all right, I make $2.96 and I pay 20 cents to get them back. So I make $2.76, and then I pay $8 in commission. So I make $2.64. So I still make more than 30 cents selling the weekly calls. It makes a big difference. All right, it makes a big difference. So basically, when you're first starting out, all right, much like a football coach, you need to know how good your quarterbacking skills are. All right, if you're a Peyton Manning of covered call and put writing, by all means, use the weeklies, unless you're playing the Patriots. All right, if you're Peyton Manning against the Bears, use the weeklies. All right, and I can't believe I'm missing the Bears game right now. If you are Colt McCoy, all right, the monthly approach might make more sense for you, the trader. All right, so if you're Colt McCoy or Cade McNown or Ryan Leaf, all right, then it probably makes more sense to do the monthly. So know who you are. All right, don't try and think you're don't try and think you're Captain Awesome if you're not. The perfect covered call. All right, in a perfect world, the underlying stock would creep higher, all right, every month, but would not skyrocket higher. All right, the trader would be able to consistently sell calls at a higher and higher and higher strike price. All right, this helps build yield. All right, the stock would never be called away except for at the absolute top. All right, and then the stock pays a dividend, further increasing yield. All right, that is the perfect scenario for a covered call. Very rarely does that happen. Now, the perfect cash secured put. All right, the underlying stock would creep lower every month but would not tank. The trader would be able to consistently sell puts at a lower and lower and lower strike price. This helps build yield in the trade. All right, the stock is never put to the trader except for the absolute bottom. And this is the time where I'll get a lot of people and saying, hey, Mark, what about something like a credit spread or something like that? Well, in order to reduce margin, I have no problem selling a cash secured put and then buying like some put relatively far out of the money that will reduce margin, and it will not create a big drag on a portfolio. It will also act as like a stop order in the portfolio. So yes, I'm all in favor of that approach. Right, but that is the perfect cash secured put. All right, so we've now Oh, game hasn't started yet. Thank goodness. All right. I knew there was a reason why I had a bunch of people listening to me rather than watching football. All right. There are some smart things that can be done to manage the sale of calls and puts. Many involved the volatility of the stock and simple decision-making of the trader. All right. All right. So type of stock. All right. What type of stock creeps higher, Amazon or Microsoft? And if it takes you more than 2 seconds to think about, then you clearly are not a student of the stock market. The answer is clearly it is Microsoft. Amazon's a flyer. Microsoft's a creeper. All right. A trader that sells puts or covered calls on a high volatility stock like Amazon is constantly being put to the, do I let the stock get called away? Do I let the stock get put to me? Do I do this? Do I do that? It just happens over and over and over and over again. All right. That volatility is a huge pain in the butt and not worth it. All right. So go for the lower volatility stocks, especially when you're starting out. All right. Now, stocks that pay dividends typically have a lower volatility. They will also have a nice dividend yield that, combined with the yield from selling covered calls, can produce a nice income stream on a covered call approach. And dividends can soften the blow of being put to in a cash secured put if assigned. You know, that happened, I'm going to give this example at the end in Oracle, where, I had the stock put to me and I collected the dividend. Great. All right. And when dividends increase, stocks increase. All right. They creep higher. And stocks that pay dividends just simply do not have as much volatility. The oil stocks, I suppose, some of the MLPs. But that's kind of a sector thing as opposed to an individual stock. But even look at ExxonMobil. Huge dividend. Hasn't gotten beat that much. All right. I like to sell covered calls at a strike that produces a net price that I would sell the stock at today. So if I buy GE for $20.15 and I sell the 21 call at 15 cents with 30 days to expiration, I got a yield of 4.9% at takeout. Am I happy with the turn if the stock gets called away? All right. If it doesn't, do I collect a dividend? Awesome. All right. Sell a call at a level that you do not mind having the stock called away. Surprisingly, you will find it's almost always at the money or near at the money. All right. I like to sell a cash secured put at levels that I would like to own the stock. All right. If I sell the GE 26.5 put at a quarter and I have the stock put to me, I am buying GE for about a 3% discount. All right. That's not terrible. All right. Again, you'll find that at the money is usually it. A trade that I wrote up this week was in Royal Dutch Shell, RDS. All right. Selling the December 67.5 put at 85 cents with the stock around 68.5 bucks. And I said to myself, will I buy Royal Dutch Shell for $67.5 minus 85 cents, which is 66.65? Well, if I consider that at that level, the dividend yield is over 5%, I said to myself, yeah, you know what? That's one that I can handle. All right. All right. So that is, how I look at things. What about just wanting income from selling puts? Well, we're going to talk about that. All right. And that's kind of where the wheel comes in. But the problem with getting income is even if you're looking for income, all right, stick to stocks that you want to own. Stick to stocks that you're willing to own. All right, because you never know when that stock's going to get put to you. All right. I think a lot of people that sold the Royal Dutch Shell 70 puts over and over and over again are taking delivery. All right. So don't sell puts in things that you won't own because guess what? You might just end up owning it. You don't have to apologize. That was a good question. All right. So again, the previous 4 slides were to prove one point. It's not the premium that matters. It's the overall volatility of the stock, that realized volatility relative to the implied. All right. Trade covered calls and cash secured puts in low volatility, low beta stocks. All right. So this is General Electric. Look at that vol. All right. So the realized volatility is about, 14%. 16% is right here, and that would be 1% a day. Well, take a look at this. I can get, in implied volatility terms, I can collect about 17% against something that has a realized volatility of under 14%. That is the time premium. That is where selling that insurance gives you an edge and allows you, all right, to get the edge in the trade. Now, one of these things, so I sell GE. Let's say one month I sell the 26.5s, and I do it over and over and over again. All right, I'm capturing premium that is lowering my cost basis if I ever take delivery. What is realized volatility? Realized volatility is how much a stock is actually moving. It's sometimes called historical volatility. All right, it's how much the actual stock moves. All right, so now let's talk about the secrets of the covered call and cash secured put. Ooh. Now, I will tell you this, and I tell everybody this. Anybody who says they have a secret and is willing to talk to you about it, it's no secret to anybody. All right? Do I have some things that I do as a trader that I do not talk about? Yes. All right? Do I have other students that show me things that say, Mark, do not tell anybody about this? Yes. All right? Do those guys think they found an edge? Yes. Now, that doesn't mean there aren't well-known ways to do things right and make money. All right? People write books. All right? So there are no secrets to anything in the trading world that people are talking about, but there are the right ways to do things. All right? If you drive a car, you go to driver's ed. If you drive your car the right way, all right, you will probably not get in a lot of accidents. All right? Same thing with options. Secret one, again, with both of these, you don't want to trade stocks that are going to go up. All right? When you trade a covered call or a cash secured put, you are not trading in something that you want to go up. You want it to not go down. That is a major difference. All right? Now, stocks that don't drop typically don't move higher quickly. That means if you're long the stock, you're going to get a chance to sell a lot of calls. That's really what you want to do. You want to sell a lot of puts, take delivery at or near the bottom, and then you want to start blasting calls and ride the stock all the way back up. We're going to talk about that. That's the wheel. Oops. All right. Find stocks that are lower volatility. All right. Transocean's never really been a low vol stock. All right. Stocks that have a lower volatility will pay a smaller premium, but will likely not fall below your break-even point. And if it does, it will only do so by a smaller margin. Look at kind of how this whole oil scenario has played out, right? MLPs have gotten slammed. Oil services have gotten slammed. Offshore drillers have gotten slammed. Who has not? Well, take a look at ExxonMobil, Chevron Texaco, ConocoPhillips, Royal Dutch Shell, and British Petroleum. British Petroleum being the worst of them, all right, gave away about 10%. ExxonMobil, same. All right, whereas Halliburton's lost about 50%. And Halliburton was probably the best of the bunch of kind of the services. You know what? It depends on the industry, and it depends on what you're getting into. You know, and it really depends on where the overall market volatility is. All right, but I typically do not think that a stock that has an implied volatility above 30% is going to ever make a lot of sense in these. All right, and by that I mean a long-term volatility. All right, you know, ExxonMobil into its earnings might see it get over 30 for short periods of time, but you know, typically you want something lower than, let's say, 25%. All right. Now, if there's something you really want to own, all right, then by all means go ahead and sell it. Right. If I want to own GoPro, all right, if I say I want to own GoPro, all right, I want to own it at anywhere below $70. All right. This is not a recommendation, but this is, let me remind you, we are an educational company here. None of these are recommendations. If I want to own GoPro below $70, by all means, blast the 67.5 puts. Blast them away until the cows come home, and then take delivery when you when it dips below. All right, but if you're looking to kind of produce an income stream, selling cash secured puts, and are willing to own what you sell if you get assigned, all right, go for the lower vol stocks. All right, now secret 3, buy stocks with growing dividends and a nice dividend stream. All right, stocks that have consistently seen an increase in the dividend have lower volatilities. All right, if one is assigned on a put or a short covered call, collecting the dividends as yield. All right, so if you're signing the put, take delivery, awesome. If you have a short covered call and you get a dividend, awesome. So get that dividend. Secret 4, only trade stocks that you want to own and have knowledge of. All right, if you know, I don't know anything. I mean, I don't have a good grip on healthcare. I simply do not. All right, it's biotechs, healthcare, that whole section, all right, is an area that I'm weak in. I'll be honest. All right, so you don't see me selling a lot of puts, all right, in Cardinal Health. All right, and then on the other hand, I hate Groupon more than anything. All right, I think it's the stupidest company on the planet. I would never want to own it. All right, I can think of no scenario where I would want to take delivery in Groupon. All right, so I don't sell puts in Groupon. All right, so if you don't want to own it or you don't understand it, don't sell it. Secret 5, if premium is too cheap, all right, be willing to say there's no option in this name that I want to sell. All right, think of buying puts in stock instead. All right, or a ratio spread or some other things like that. All right, think of buying calls. All right, if you can't find anything that you're willing to sell, that means there's probably something you should buy. Does that make sense? All right, and again, it almost never makes sense to sell an option worth a dime or less, and when options get below a nickel, we buy them back. If you take one thing away from this, I hope it's that chart that I drew out with the real premium decay. All right, so now let's talk the triple income wheel. And this is the best way to use calls and puts in tandem. All right. In the wheel, the trader is using 3 sources to produce income. All right. Source 1, and this is where you start. The first rotation of the wheel is start selling puts. All right. Follow the secrets. All right. Find something you want to own. Find something that's low vol, that has something you want to sell. It has a put you want to sell in it, and start selling it. Royal Dutch Shell, perfect example. All right. RDS, we can even look at Royal Dutch. I need to do RDS/A. There you go. All right. So let's say Royal Dutch Shell, 67.5 puts, I'll sell at $2 till the cows come home. All right. Awesome. I'm going to sell those over and over and over again. All right. Sell them at a lower and lower price. And now, do I think oil could go lower? Yeah. Do I think Royal Dutch Shell could dip below 67.5? Yeah. Hopefully not before January. Now, what would I like to happen? Hey, maybe I buy back those $2 puts for a nickel or a dime. All right. And then in February, I sell the 65 puts at $2. And then at the bottom, here's hoping, at the bottom, I get a signed Royal Dutch Shell. How awesome, all right? And then Royal Dutch begins to rally. All right? So I'm going to keep blasting these puts month in, month out, month in, month out. So if I do 5 $2 put sales in Royal Dutch in over a 5-month period, I've got $10 in my pocket. So so let's say Royal Dutch finally dips and I take delivery at 65. Well, what's 65 minus $10? I'm long from $55 in Royal Dutch Shell. Awesome. What if the stock moves up? Well, that's a great question. So what if the stock moves up? So at a certain point, you have to say to yourself, well, do I still want to own this? All right. So Facebook, for instance, I was selling, will I take delivery at $72? Maybe. Will I take delivery at $77? No. All right. So if Royal Dutch goes to, let's say, 70, will I blast the 70 puts? Sure. All right. Will I blast the 72.5? Sure. Will I blast the 75s? The dividend yield then is 4%. So maybe. All right. What about 80? Well, now we're dealing with a dividend yield that's, in the, maybe lower than 3%. Maybe not anymore. All right. So I will sell puts at higher levels. All right. Until I take delivery, as long as they're at levels that I want to own the stock. All right, now, source 2, the dividend. Once the stock is put to the trader is now able to collect the dividend. So I do, let's say, I do 2 put sales in Royal Dutch, and I collect $4. All right? I then take delivery. All right? Well, now I've got this long stock that pays a 76-cent quarterly dividend. And I'm taking delivery on that. Awesome. Do I have a rule of thumb on how far out to sell puts? 30, 60, 90 days. I like to go closer to 30. Yeah, about 30 days, 31 days, something around that is typically where I'm looking to sell. And I'll answer the Apple question at the end, so remind me to answer that. So I'm looking at about 30 days typically, or if I'm really active, I could do weeklies. Again, do those weeklies and to take delivery. I'll tell you, I've been doing this Oracle trade, and I'll walk you guys through where it is. All right. Now, younger traders, and this is one of the things. So once someone has, so if I take delivery on Royal Dutch, I'm 36. I'm going to put that on a drip, and I'm going to try and accumulate more shares. And I'm going to hope that I can ride Royal Dutch up for Who knows? So if I buy a 10 lot, or if I buy 1,000 shares of Royal Dutch, and I'm collecting that 76-cent dividend, all right, and it's trading, let's say, for ease, $76, all right, I'm buying 10 shares, right? Yeah, I'm buying 10 shares with that dividend. All right, so if I hold it for, let's say, 10 dividend periods, next thing you know, I've got 1,100 shares, and I'm able to now sell, you know, the more of the next part of the trade. All right, now, if you are older, pocket the dollars. Time of the put sale is essentially X date. No, I mean, that's just where you're going to take delivery, you know, if it falls below at expiration. All right. Now, if you're older or you're doing this in the company that you work for, keep the dividend. You know, I am a firm believer, if I had my choice, people would never trade the wheel or short puts in the company that they work for. All right. Why? You ever heard of the term Texas hedge? Anybody here know what a Texas hedge is? If you know what if you tell me what a Texas hedge is correctly, the first person to do it, I'll send him a copy of my book. I believe we have a correct answer. The answer was double up. All right. So what a Texas hedge is, if I buy calls and then I buy stock at the same time, that's called a Texas hedge. All right, because you're doubling down. All right. Now, if I work for the company and I'm trying to acquire more and more shares, well, I'm placing a lot of my wealth in the same basket. All right. So that is why I don't do that. All right. Now, finally, source 3, sell calls. All right. In addition to collecting the dividend, all right, once a stock is put to the trader should begin selling covered calls. Calls should be sold at the strike the trader was put to or higher. Recall that even if the trader buys and sells the stock at the same strike, he or she will collect all that triple or minimum double income, right? So if I sell a 40 put at $1 and I take delivery, and then I sell a call, a 40 call at $1, and I get it called away, well, I held the stock for a little bit, but I got $2 in my pocket. If it paid a 25-cent dividend in that period, all the better. All right, so here's an example of a full rotation. All right, so now the tips. Once a full rotation of the wheel happens, wait a day or two before selling puts again. All right, examine to see if there are better sales. All right, once someone has no position, spend a little time figuring out whether there's anything else you want to do. All right, like a long position, if the trader owns the stock, he or she still needs to have a max loss on the long position. All right, and if assumptions change, stop. IBM used to be like the quintessential wheel trade, all right? Then everything changed, and now it is not. It's like, you know, it's like how the Grinch stole Christmas, right? You know, his heart grew 3 sizes too small. IBM kind of did that in reverse. And yes, I did just read that to my kid while he was in bed. Yeah, we'll be sending out a replay, don't worry. All right, so here's an example of a trade that I did back in September, and I've actually been selling puts in Oracle now, again, for the Street. This was written for TheStreet.com a few months back. So on September 9th, I sold the September, and this was a weekly trade. All right, I sold the September 26, 39 puts at 22 cents. The stock was put to me. All right, on September 29th, all right, I then sold the October 3 calls, 39 calls at 13. Didn't get called away. I then sold the 39 half call at 13, and I collected a 12-cent dividend that week. All right. Then the following week, I sold the 39 call at a quarter. Then the following week, I sold the 39 call again at 24. All told, in 5 weeks, I made $1.09 in triple income. That's a yield of $1.09 over 39 bucks, or 2.7%, annualized 29.6%. And notice, the way I would do this would basically be I would sell on the Monday, and then, you know, I would be out on Friday, and I would just be naked the stock long over the weekend. So in summary, high flyers aren't for premium call sales or puts. Turtle stocks are the perfect for covered calls and cash secured puts. Learn the secrets and trade the wheel. Now, coming up next week, if you found this compelling, you will love this course. All right? Because it is our Option Pit Boot Camp. It is 4 hours of, you know, call it 7 to 8 hours of live online training. All right? We're going to teach you how to understand how volatility can improve entry and exits. We're going to increase profitability of directional option trades. We're going to manage trades to reduce risk and maximize profits, and you're going to learn the power of delta neutral trading. So we're going to cover kind of the entire option world. All right, give you we maybe, you know, you might not learn everything that you need to know, but you'll be aware of everything you need to learn. All right, and how to go find that. And we're gonna give you all the tools that you need to figure out. You know, none of our courses are ever kind of a purposely an upsell. All right. So, and, you know, I'm going to change this Sunday. I meant to make that Sunday. All right. So we're going to give you a lot of good information, and the stuff that we don't give you, we're going to make sure you're aware that you don't know it. All right, so you're going to know a lot of stuff when you're done, and you're going to know what you don't know. All right, and normally we charge $395. The price is already graded $147. Enroll by Sunday, and we'll take $42 off of this. Use code WHEEL. If you've already done something else, sorry, or if you've already enrolled, sorry. I will make up the difference on your next purchase. All right. But so use code WHEEL to take off $42. All right. It's not a bad gig. All right. And so you go to optionpit.com/bootcamp to register. If a dividend is coming up, so here's a couple of questions. All right. If a dividend is coming up and you really want the stock, do you ever buy the stock and sell the call at the same time? Yes. Can you enter the wheel with the covered call first and then move into the put? Sure. Sure. But that's not really, that's more of kind of a straight covered call trade than a wheel trade. I wanted to take your directional course. Will this course cover that one? It's going to cover some of the pieces. All right. If you want to take the directional course, shoot me an email, and I can get it to you cheap. Because that was a great course. And so it's a really nice course. Optionpit.com/bootcamp course. We use code WHEEL or WHEEL, and you know, let me know. What are the hours? So we're going to be doing it. It's going to be Tuesday from 6 Eastern till about 8 Eastern. All right, and it's recorded. So it's taught live on Tuesday, Wednesday, Thursday, and Saturday morning. All right, so it'll be Tuesday from 6 to 8, Wednesday 6 to 8, Thursday 6 to 8, and then Friday, and then Saturday from 10 to noon. All right, and we're going to send you the recording at night and the slides. All right, and so you'll have Friday review stuff if you miss it. And then after the course, I'm giving everybody that signs up 1 free week of Option Pit Live as well, which is our chat room. All right, cool. HWIP Cool whip. Yeah, cool whip. Is option volume or open interest an important consideration? Not for this. It makes some difference. It matters for some of this, but it's less important for this approach to trading. Obviously, if you're trying to do a wheel trade in something that doesn't trade ever or trades by appointment, you're going to have to hit the bid or lift the offer. So that's where the weakness is. But I've always found, option volume has some value. Open interest is less important to me. So someone asked, Apple Jan 14 options are under 25 implied vol. They pay 1.6 dividend. Is Apple a good candidate? Apple is an interesting candidate. I don't think it's a bad candidate. Let's put it that way. Apple goes up, but I'm less inclined to think it's going to go down a lot. So it's certainly converting into one of those candidates, if you will. All right, any other questions? All right, everybody. Well, I want to thank everybody for coming. If you've got questions, you can email me, info@optionpit.com, market@optionpit.com, or you can call us 888-TRADE-01. Hope everybody has a great evening, and thanks for coming. I'll have the recording out tomorrow. Have a good night.